Well, your house, for many people, is the most expensive and the biggest asset that you'll ever own. With your car, I suppose, and many people see their house, when they buy a house, as a genuine asset. Is it, though? With us is Troy Laas, head of distribution at Stringfellow Investment Specialists. So we have to be careful about seeing our house as an asset.
Very much so. I mean, in terms of an asset, you know, if you look at the book by Robert Kiyosaki, I mean, he mentions it as well, in terms of the fact that a house is something that you reside in, so you're not going to get any income from it. If anything, you're going to be putting money into that particular property, and that property is bonded off, so you've got a debt instrument to keep that, what you would call an asset. So, you know, it's not, therefore, from that perspective, I don't see your own house, or your home, shall we call it as such, as an asset. It's only time it really becomes an asset is in terms of your death, because you're no longer residing there. Well, hopefully you're not residing there, then it becomes an asset to somebody else.
On that note, though, the typical South African mindset is that you need to have a primary residence and then invest in either tangible bricks and mortar property in order to derive a secondary income. Adapting this mindset of looking at your home as not necessarily an asset, how long will that take us, and what are the alternatives then?
Look, in terms of property being an asset, I mean, property as an asset class, it's definitely from that perspective. It's just with more regards to your home. And even in terms of residential property, buying and selling property, you know, you're going to look at it as if not putting all your eggs into one basket, only that particular thing. And you must also remember it's bricks and mortar. It's not liquid cash. Plus, then you've got to look at how do you finance that investment, or asset, as you want to call it that, in terms of property. And at what rate? And I mean, you've got to look at sort of the prime rate at the moment is 10.5, and there's very few people who get below that sort of rate. Then you've also got to look at the maintenance of that particular property. And with inflation being where it is, it's a bit of a concern. I would probably say that if you wanted something, you wanted to go into the property, I think an alternative would probably be more a property unit trust, you know, listed property. And then you're getting an exposure to not just residential, you're getting commercial, offshore property. It's liquid, and it makes far more sense. I mean, in terms of property in itself, property has outperformed equities to a large extent the last couple of years. Over longer periods, equity is high, but property is not far behind. But you must just remember, property is still seen as an aggressive investor when you go that particular route. So you've got the liquidity, okay, but don't see it as a guaranteed investment.
So maybe you've got to use different language and talk about your house as not an investment, but as something that you pay for and to live in. So instead of paying a 20,000 Rand bond, say, every month, thinking that you're investing in your house, rent a house for 10,000 and spend 10,000 on a property unit trust if you want to invest in property.
Yes, you know, property, it's by all means, I'm not encouraging that people don't buy houses. I mean, you need to.
It's how you think about it.
Yes, it's just in terms of how you look at it. You know, the other thing that also people look at is that they say, no, well, I'm going to downgrade my house. I'm going to get a smaller house and then use that particular money. Or I'm going to access my access bond and use that particular money. You must remember that, again, if you're doing the access bond, it's a debt instrument you're using. It's not giving you a return. In fact, you're going the other way around. It's costing you money again. So
it's going to cost you a lot more when rates go up.
Definitely. And that's another factor you need to take into account. Look at, we had low interest rates for a couple of years. Now, the low since 1974 at one stage. And people were buying and overextending their bonds and that type of thing. And you've got to go back to 2006, the bubble in the US, and what led to the downfall of the market. And that was property. So we can't be doing the same thing here in South Africa.
Is there a bubble developing in South Africa?
You know, there's talk of a bubble. I mean, but I don't think we're ever near that sort of level. You're going to look at, so the return on property, if you look at the FNB, they've got the index which they release on a yearly basis or annually, and that's at 7%. You know, if you look however in South African property between the year 2000 and 2006, the growth was 20%. It slowed down after 2006. You must remember in 2008 we had the National Credit Act that then came and made it a lot more harder for people to get property, and that, I think, prevented a bubble from bursting, because if that National Credit Act hadn't come into place, I think we would have had a problem.
Do you see a change in behaviour?
I do see, in terms of it from an investor, I think investors are becoming a lot more astute and a lot more aware through social media and everything else. So I think there is more of a swing, and I also think in terms of property, I mean, you just have to look at how many malls. We listed 6 in the world for shopping malls. So there is a demand for property. How long that's going to last, that's another question.
Well, we'll leave it there. Thank you so much for your time and providing insight. That was Troy Laas, who's the head of distribution at Stringfellow Investment Specialists.